Hey, we're live and we're back with the Holy Macro Show, and there's been a lot going on lately. Man, the market has been resilient, interesting, and I really wanted to get Kashop's take on some of these things because I keep seeing this market that's like resilient and just keeps moving up. And Kashop already knows my views on this. I'm probably long because I'm a trend guy, but I know Kashop also looks at a lot of other things that I don't look at. And so looking at the fundamentals, looking at the global macro, looking at the geopolitics. So understanding those things, and yeah, I understand those things and I look at those things, but Kashop looks at these much deeper. So I'm kind of trying to get an understanding of where do we think we are in this cycle? Is it a thing where it's just going to continue to be this raging bull market forever in technology, which I don't even think that's true myself? Or do we think it's something that, hey, people are getting ahead of themselves? They feel like they won after the Liberation Day drawdown, the Minsky moment that you called out, and then now everything's fine, and we're just going to go to the upside, and everything's beautiful, and there's sunshine and rainbows.
So I definitely don't believe it's going to be that way. So the Minsky moment, it happened, and then we got the dead cat bounce. And somewhere along the way, what happened was the dead cat bounce turned into a blistering rally. And that's partly because, I mean, you saw the way the market collapsed, absolutely collapsed in April. And there is no way that was sustainable. And the reverse reaction, there is no way this is sustainable. Now, if you look at the way the dollars move, for instance, you see a kind of move that can be explained based on the fundamentals, technicals, whatever other factors. And that's a kind of move that can last. If you see the way the S&P or the Nasdaq has moved, that is not the kind of move that can last. Like V bottoms are very, very rare. Yes, we had that in COVID, and that was because the Fed unleashed a bazooka of money, and they are not doing that this time. And I know everyone's always hoping that every problem in the world will get solved as long as the Fed keeps printing money, but at this point they are not doing it, and the market's always going to front run the Fed. And the market, I think, is now so far ahead of the Fed that there will be a reality check, and that's when you will see, I don't know if it will be a crash or if it will just be a controlled drawdown all the way down with some scary dips. Or I don't think we are going to see the kind of crash that we saw in April, because that was just ridiculous. So I think we are probably close to the peak, and from now on it's going to be rotation, rotation, rotation. So this is just a dead cat bounce turned into a crazy momentum rally. And if you look at even the Magnificent Seven, none of them are leading except for Nvidia, which is making new highs. And if you look at sentiment around Nvidia, the last time Nvidia was making new highs, everyone was long. And this time you have all these fund managers saying they are out. Even in fact, the most ardent AI bulls, even they are saying they are out because they can't make sense of the valuation. And of course, they see better opportunities elsewhere. And if you look outside the US centric view, first of all, what do you see? You see crazy rallies across the board, whether it's Europe, it's Asia, it's Latin America. You see, in fact, currencies have moved more than the S&P this year. All the S&P has done is what? 5% with a lot of volatility. 10, 20 currencies have done better than that with very little volatility. So you're seeing rallies across the board. And the common factor for all this is the weak dollar, and the dollar just keeps getting weaker. And the more there is uncertainty in the world, earlier dollar used to be a safe haven during uncertainty, and now it's the reverse. The dollar is getting sold with the uncertainty, and the reason for that is, if you go back to 2011, the eurozone crisis, the problem was in Europe, so the rally was in the dollars and yen. If you go back to any other period, the problem was in some other country, and the rally was in the dollar. And now, if you come and look at this period, the problem is in the US. So, of course, the dollar is not going to rally. And what do I mean by the problem is in the US? The problem in this sense is the policy uncertainty. Tariffs are on one day, off the next. How do people make trading decisions? And I'm not talking about clicking a button and placing a trade, but I'm talking about, do you order goods from China or not? Do you prefer your supplier in Vietnam or do you prefer your supplier in China? Do you take immediate delivery, or do you wait until there's more clarity on whether these tariffs will get reduced? So all these issues go into supply chain planning, and those are incredibly hard decisions. Now, if you are cutting down inventory because of this uncertainty, you don't need as much working capital in US dollars anymore. So if you are a trader in a different part of the world, the only reason you hold dollars, I'm talking about physical traders, the only reason you hold dollars is trade settlement. If trade is not happening, you don't need those dollars. So what do? You convert your dollars to your base currency. You hold less working capital in dollars. And this way, the usage of the dollar in global markets is shrinking. And this shrinkage, there is no possibility for this to reverse. And there is no possibility for this to reverse is the reason is it's such a powerful trend, and it's undoing about 10 years of a dollar bull market in terms of its usage, in terms of its over-owned position in terms of the other world currencies. So when this reverses, it's not going to stop. There is no fundamental force that can stop this. So I think what's going to happen is you're going to see crazy moves in the markets, which all feed off this weak dollar.
I think that's the trade. If I just really have to think about this in a way where I look at the global macro, like the trade is just the weak dollar trade. Like I don't know, like everybody's like, oh, what about this country, or what about copper, or what about gold? It's all the same trade to me, and that's the thing. Like we've been talking about that all year. We talked about it last year. When the dollar continues to move down, we're going to be in a situation where we will see money flow into different areas and different things. An interesting one I actually did, and you and I haven't gotten to talk about this yet. I did a study. I saw somebody said, oh, April, the dollar was down, bonds were down, and stocks were down, and that hasn't happened in the last 5 years or something. And so I thought that was ridiculous. I was like, there's no way, that had to have happened at some point. And so I went back 5 years. No, he was right. 10 years. No, he was right. I had to get back to the 80s to find a period of time where all three of those went down in the same month. I mean, that's wild to think. But once again, that was when the Japanese trade started. So the Japanese trade took off at that point. The only time that was similar was a time where stocks and the dollar were going down. That was 2000. And that also led to the big rally in China, in Brazil, in Latin America, and so on. So it's like this is all one large trade that's setting up, and everybody keeps thinking it's going to stop. And I can't see the reason why the exodus outside of the U.S. will stop. It doesn't mean I think that, hey, gold miner, you could have some U.S. gold mining stocks. You could have some energy stocks. Sure, even tech looks fine right now. You want to be long it. But at the end of the day, it's like, what's the big picture trades? And I think those big picture trades are things like copper, things like gold, commodities generally, and then also looking at the international stocks. And the currencies against the dollar have done phenomenal. I mean, the one thing that's very interesting to think about is who had the euro as the leading currency this year on their bingo card? I can't think of anybody, especially me. I got long a bunch of the currencies at the beginning of this year because we had a mispositioning in the dollar. And so I get long the Swiss franc, the Canadian dollar, Aussie dollar, the Kiwi, a couple others. Never even thought of the euro. I was like, oh, I don't even want to touch this thing anymore. I haven't had it even in the signals in the portfolio for a long time because I'm just like, it's always the worst performer in the bunch. But now the euro is the best performer. Our European, we're holding Germany, Poland, a couple others in Europe. They're all outperforming just about everything. I mean, it's wild to see Europe out of everything leading the way once again. What do you think about that? Like Europe is outperforming. That's crazy to me.
I think I think you have to understand it in terms of the flows. So since the eurozone crisis started, institutions, individuals, everyone across Europe has been pumping money into the United States. They have been doing that for 15 years. And I think that reached a peak when you had the Swiss National Bank buy Supermicrocomputer, even though it was, guilty of committing accounting fraud earlier and getting delisted. They did not care. They just bought the stock because, hey, AI hype, we just go along with it. And I think that kind of was the pinnacle, that was the peak. And since then, Europeans have come to their senses. They see what's happening with Trump. They see how every day Trump changes his mind and threatens one European sector or the other with tariffs and tries to interfere. Elon Musk tries to interfere in German elections. So they see all of this and they're like, hey, wait a minute. I don't trust these guys. Why do I have all my money there? And once they started asking the question, they started pulling their capital out. And it's a reflexive loop. So once they pull their capital out, the euro strengthens. And the other guys who are still holding US assets, they are like, the euro is strengthening, my PNL is in euros. And because I have too much dollar exposure, the value of my portfolio is declining. So what do I do? So I'm going to pull. And just as for the last 15 years, they've been flooding into the US, now they're starting to flood out. And this is again a trend that cannot be stopped. And that's the only explanation which makes sense. Because if you ask me, why is the German stock market doing so well when the economy is not, there is no logical reason. This is the only explanation that makes sense, so it's probably true.
Oh yeah, and honestly, to me, it's a the market's always going to front run the fundamentals, but once again, it's like, when would that change? When would the fundamentals change in Europe? But it's crazy, and for me, I'm very happy to take the trades. The price action always leads. I can explain it at some point in the next 5 years, maybe. But like, I think you're right. It's the flows right now. It's the positioning. The positioning is so important as a trader, and people don't think about it enough. When you have so many people going, Europe can't continue to move higher. Europe's been dead for years. I don't want to buy international stocks. They're, ridiculous. It's a way to lose a lot of money. Look how bad they performed over the last 10, 20 years. So people continue to do that. And when that happens, like, who's left to sell? Like, there's nobody left to sell. Like, so, getting long something like Poland, what is it, up 50% now? I mean, every time I look at it, it blows my mind, because it was like 30% earlier this year, then it hit 40, 45. It's got to be near 50. But these things just keep continuing. So I think it's really an interesting thing to continue to keep an eye on this year. And I hope more people continue to be interested in international stocks, because they make a lot of money, and you shouldn't just be US centric as a trader. Like, if you're trading, not to mention other people, they have no idea things like what is it, Spotify is actually a company that's outside the United
Yeah.
States. And like, so you have a bunch of these companies that people know and love and they use every day, and they have no idea they're not in the United States. That's fine, but educate yourself on it, understand the areas that these things are in, and then you can find different ways to outperform when the US market isn't performing. And also a thing that's and Kashab, you probably even remember this, because we were talking a lot about this at that point, which was 2019, which is, I was long Greece, which, like, this is after the banking crisis. Every bad crisis in the world happened to Greece, but then it gave buy signals. It was giving positioning signals, and so I get long Greece. Same thing with Russia, and there was one Brazil that year. And so those three countries I was long that year, and they all outperformed the S&P 500. And at the time, it would still, like, even today, everybody goes, well, nothing outperforms the S&P. You got to be in the U.S. and so on. It's like, that was a year that international stocks didn't do great as a whole, but you had these outperformers in there, as long as you just understood like where the flows were going. And so I think it's always important to continue to look around. So I have this gold chart up here, but I want to ask you first, how about platinum?
Oh, it's a very tough call. So if I'm allocating to the entire precious metal sector, I would say I would go with gold as a safety trade. Silver, little bit of risk, but should do well over time. And platinum is like the wild card. It's like the money you throw into options. And the reason for that is, like, everyone knows there's a supply deficit. So That is not a secret. In fact, you look at any metal, you can make the case that there is going to be a supply deficit. Uranium, classic example is uranium. Uranium is up a lot this year. Uranium is up close to 8, 9x from its 2015 bottom. But the entire period, there was the case that there's a supply deficit and the trade did not work. Now, I think it's the same case with platinum, same case with palladium. There is always the bullish fundamentals. But as a trade, I think it's probably something you want to put on for 3 months, 6 months, maybe, and then take your money and take it back into gold, because I really don't see this being a long-term trend. Now, the reason I'm saying that is because it has both industrial uses and precious metal uses. Now, if you look at the precious metal use, first of all, gold is in a raging bull market. It's been more than 1.5 years, and still nobody cares. So there has to come a point where everyone is into gold, and then they are chasing the next trade, and they get into silver, and then they are chasing the next trade, and they get into platinum. I don't see that happening yet. I see this is going to take a long time for even gold to get mainstream attention. So I wouldn't bother going too heavy into silver, sure, but platinum, not really. I would just treat it as a trade. And as for palladium, I really don't know what's going to happen with the demand for internal combustion engines, with the EV craze and everything that's going on. So I would just avoid it altogether. Yes, the supply deficit is there. The charts look good, but this is a market that tends to spike and correct, spike and correct. So unless you are really good playing both the trend and the mean reversion, it is going to be a tough trade.
Yeah, I think there. One is I like the platinum trade and I like the palladium trade, and I give you the reasons why. It's one thing. You and I have been pounding the table on gold for way too long with nobody caring at all. We've been talking about it. This move that's happened has been great, and nobody cares at all. But the thing that's interesting is that the cycles always work the same. And what's interesting, and you know this from studying history, everybody thinks cycles change every single time. And for me, it's can they? Sure. I absolutely know they can. So I'm always ready for that. But at the same time, if the playbook's been the same every time, that gold moves first, and especially if you add in the central bank buying the last couple of years, it makes a lot of sense that it's outperformed quite a bit. And then if you look at the miners, you're like, okay, then the majors, we saw a couple majors hit new highs. I think AEM was probably one of the first. And then we saw silver try to make a move. And then GDX started to move. And then GDXJ has been crazy. I think it's up 60% this year. So the junior gold miners started to move. And then we saw silver finally get over that major level at 35. That's a very significant level, something that you always have to pay attention to. But then it was, the cycles changed, Jason. If you look at platinum, now once again, platinum is a tough metal to trade. So I agree with Kashap on that. Same with palladium. It's a tough metal to trade. One of the toughest trading vehicles, and you have to have a very large portfolio to even trade it well because the volatility is big, the contracts are big. So be careful with trading these things. PAL is an ETF that's actually pretty decent if you do want to get into that space. But once again, it's just going to be it's going to go back and forth quite a bit. I don't know if I think of palladium in the cycle for precious metals, but I definitely think of platinum in the cycle for precious metals. I think that's the last one to really take off, and it never makes sense. Back in the 2000s, if we think about it, sure, it was different. People were more interested in it. People were going on TV with their grills all out of platinum in their teeth. And then they, platinum rings were big. Platinum was everything back then. So that made some form of sense. But, now it's still I don't know what sense it makes, but I know that the cycle works almost the same every single time. And gold's been moving. Nobody cares. Silver's been moving. Nobody cares about that. Nobody cares at all. And now platinum's moving. I just think it's not a fundamental reason, right? It's more of the cycle's working this way. People are just trying to get into the next thing that's going to move higher in the cycle. But once again, platinum could be up 50% this year today, and it could be down to 20% this year in a week. So be careful with that one. It's also a volatile product. So the biggest thing and biggest takeaway from what we both said is platinum, palladium, very volatile products, hard to trade. If you understand them in a way that you can trade them, fantastic. I think they're worth taking the trades on. But also don't feel like you missed out. There's lots of miners. Gold will probably continue to move. Silver's probably just getting started. So I think there's a lot more upside to go.
Yeah. And of course, there's also copper. We haven't spoken about that, but it's actually a lot easier to trade copper. Like the volatility, everything, it's so much easier to trade right now. And I'm not, I can't believe I'm saying this, but it actually feels like natural gas is a very, very tradable product compared to what it used to be. What are your thoughts on that?
So you're not wrong. So the volatility of natural gas has dropped quite a bit. So when I first started trading natural gas, the trailing stop in my time frame was around 35%. So that's huge. That's actually more than my trailing stop for Bitcoin. So that's the most volatile asset at that point. And then as the years have gone on, now it's like I'm at like 27%. That's crazy to think of. That's dropped in volatility considering everybody thinks it's the worst product. It's so volatile. It's the widowmaker and so on. Like everybody says these things, but I think that if you continue to take these trades and all these, like to me, it's more of a, what are you doing as a trader? If you're a trader and you're trading all these different products and some are like, you look at palladium and you go, this is extremely volatile, I can't handle all this volatility, then you got to size it smaller. And it's hard to do in futures if you're unless you have a very large account. So it's hard to do that if you're going to trade in the futures space. But once again, let's say all the contracts are small and we're able to trade all of them and we have a huge portfolio just for this hypothetical situation. I think it's more of a understand the product you're trading. Like now you understand natural gas is volatile. So I don't need if I have a $100,000 account, if I have a $100,000 position, I'm going to get killed. Like I'm going to lose probably 30% of that, possibly twice to get one trade. So I'm down 60% before a trade that I think might work could even happen. I mean, that's how you get hit. So it's all about position sizing small and understanding like these products are going to be wild. Like there's never going to be a day where I put on my trades and all these different commodities and I think like, yeah, this is going to work and this one's going to be easy and my natural gas is going to go up here. Or palladium, hey, like I see platinum moving, I've seen silver move, and then after those have moved, now this one's going to move and it's going to be great. Like it could I'm long palladium at the moment, but it could literally just come back and just kick me in the head any day now. Like I know that's how this game works. So you have to understand the risk management aspect of commodities is it's way more insane than in the ETF or stock market because of the leverage. Like the leverage part of it, as you know, is the final piece. It's almost like I've talked about this before, but I feel like there's like a bunch of different ways of trading. Like you learn fundamental, you learn technical, positioning, whatever, market structure, there's a million. But the other one is leverage. How do you trade with leverage? It's a whole different game. Like somebody was talking about, I saw somebody mention on Twitter the other day about buying dips. It's like, yeah, you can buy dips, sure. Like if you are buying the SPY ETF, if you are buying the biggest names in the market, sure, you will probably be okay. Will I do it? Probably not, but you will probably be fine. But if you did that with small stocks, if you did that with leverage, if you did that with options, like you're going to lose your ass. You're going to be broke within weeks. Like that's how this goes. So understanding the difference in like, how do I trade with leverage? Then how do I size these properly? And then how do I run a trailing stop on something that could move 35%? And when you can answer all of those questions, because it's funny, I bring this up a lot, and like everybody will hear about my Bitcoin system, which fantastic system. It's one of my best. It works really well. But to run it, you got to run a 33% trailing stop. That's insane. That's insanely wide. People think, I'm talking about like, hey, I'm once again $100,000 portfolio. I got $100,000 in Bitcoin. I'm running a 30% trailing stop. That would be insane. But if I'm running, $3,000 in Bitcoin and I'm running a 30% trailing stop and I'm losing $1,000 or something around that number per trade, then it doesn't matter at all. And so that's really the secret, but it's hard because then people go, I just had a investor call this morning and ask about a couple trades, and this thing's gonna happen, I think. Should we add to the size here? Like, what are you talking about? Like, yes, of course, if it happens, that's really cool. We could double up and we could get all the leverage in the world, and do that. However, trades go against you sometimes, and a lot of the time. Like, that's the thing that we don't say enough in trading, that new traders learn the hard way every time, which is trades go against you more than they go for you. And if you can size them properly and you're only losing 1% on those losers of your portfolio, or 2%, keeping it small. Like, I don't know the exact size of your portfolio, so everybody's going to be a little different there. But if you keep those small and you know how to make your winners bigger, like, you can be wrong a lot and you can be right just a couple times. It's, for example, if I'm running a 1-5 ratio, so that means I can lose 1% of my portfolio to make 5% on a winning trade. I can be wrong a ton. I can be wrong all the time. Paul Tudor Jones had a funny quote about that, which is, he said like something like, I can be a bumbling idiot and still figure out a way to make money being right about 20% of the time. And it's true. It's not that you like plan to be right only 20% of the time, like, but there's going to be a month where you're only right 20% of the time. Like, that's the hard truth that I try to tell traders all the time, that they're like, no, but like, if you're running any sort of strategy, any sort of trader, I don't care if you're discretionary, systematic, whatever it is, there will be a time where you are just going to be wrong so much. And it's not
like Paul Mulvaney, 55% drawdown.
Yep.
That made the news. Yeah.
Yep. He was all over the news, just like the last few years, best performer, best trader. Everybody was asking me about pyramiding. Hey, should I start pyramiding as a trader? And I'm very against pyramiding. And I'm like, yeah, Mulvaney does it and he's good at it, which is awesome. I love to see it. But at the same time, those drawdowns are going to be nasty. Like, you're going to have some serious issues when you get into those drawdowns. And he's fine with that. That's the way he's always done it. I respect that's the way he trades. But also, like, you got to be ready for that terrible time. And like we were just talking about, he had a period where he was just right just a little bit of the time. Then you have a situation like the February options expiration, which led to a big drawdown. And then you had Trump kind of come in and say something about Liberation Day. And then basically, like, if you're a trend following trader, you're hitting a bunch of stops. And so you're hitting a bunch of losses and you're not hanging on to those trades because like you don't know that it was going to bounce back like that. So they just got killed. And he doesn't I run multi-strategy. He just runs trend. So if you're running multi-strategy, maybe you bought a mean reversion, maybe you did a couple things differently. But if you're running trend only, you're waiting for the next breakout, which is happening now in technology. So like you've waited this whole time basically to get back long on the upside. And I'm not making fun of that. That's fine. That's the strategy that he runs, and he kills it. He's been performing better than almost every trader over like 20 years or something. So like, not hating on it, but just saying that's how this happens. And it's not a bad thing, but I'm just telling everybody it can happen to them at some point, and there's nothing wrong with that.
So how do you I mean it's fine for Paul Mulvaney, he runs a fund, he has assets outside of his fund. So but when you're trading for a living, how do you handle a drawdown like that? How do you even bounce back? Like you've had drawdowns, I've had drawdowns. So what happens when you take that kind of a drawdown? Do you give up on the system? Do you just go back to scratch? Or what's the way of recovery there? I think that's the part no one really talks about.
I don't do anything. That's the actual answer, and it's the hardest thing to do. I used to do things. I had investors that would drive me crazy, at certain points, and they would be like, "Hey, can you do this?" Like, "Hey, we're not performing well. Let's do this differently." And the one year I did, the one year, and like I was performing well for years. I had no reason to do any of this. So I start to change the system, the strategy, do things a little bit differently, trade outside of my realm a little bit, and it was just terrible. It worked out terribly. I was fine. Like I think it was basically flat performance from that point on. But all the returns I would have made if I kept the strategy the same were insane. And I went back and just did all the trades the way I would have when I looked at the year, and I was like, I would have created another 40% if I did nothing. But because I changed so many things, because that's the thing, at the end of the day, it's like you got to figure out what type of trader you are. And that's the hardest thing to do as a trader. Figure out what type of trader you are. Figure out that I can take trends. I'm a good trend follower. I'm a good mean reversion trader. I'm a good fundamental trader, whatever it is. And then move that direction. Continue to put on those trades that way over and over again. And there will be periods of time. This is the hardest thing to think about. There will be periods of time where your strategy is going to suck. George Soros said that, there's periods, he said, in my portfolio, there's times where the market's not doing anything and my strategy is worthless. And this is true for every trader. Like you can run multi-strategy like me. There's times where I'm running multi-strategies and nothing's working. Like it's whether it's mean reversion, whether it's breakouts, volatility breakouts, whatever it is, events trading, like whatever it is, none of them are working. And this gets really frustrating when it first happens. Over the years, though, as I understand, like, hey, like this is just part of the process. Hey, I'm gonna go through this drawdown. I'm fine with it today. I feel great about it most of the time because I'm like, oh, good, my strategy only lost this much this time. Like I figured out how to really cap that drawdown. Because really, at the end of the day, it's a game of keeping your drawdowns small. If you get to those 50% drawdowns, you got to make 100% to get out of it over and over again. It's gonna wear on you, and then it's just miserable to handle those. But if you can go, okay, my drawdowns are small. Yeah, my strategy, it's underwater right now. The market's let's say you're a breakout trader only. The market's chopping sideways. I'm a breakout trader. I'm losing my ass. Every single trade is getting me 1% stop over and over and over again. Let's say I've lost 20% at this point. I'm gonna be happy I only lost 20%. And then I'm also gonna think about, okay, well, my strategy is working fine. The market's choppy. And so just understand where you're at. Like if you can understand where you're at, and not to mention the biggest thing to me and you as well, which is being open to trading everything. Like if you can trade, like if you can get in the commodities market, you can trade these different countries. If you're a stock trader, you can trade different places. You're going to have a lot more luck than the guy who's like, yeah, I'm trend following on the S&P and that's it. Like you could be in 5 years of sideways chop. You could be in, a period of time where your strategy just works terribly for a long time. So the diversification helps. But the other thing, like you said, as an individual trader, I think it's so hard to trade as an individual trader and not have any other forms of income. I think that's the toughest way to do it. I always caution people against it. And it's not because you can't do it and because you're stupid, which is what everybody thinks. They think I'm just calling them stupid. Really, I'm saying you're going to make huge mistakes based on the fact that you need money from the market. It's so tough to be objective as you're in the market, moving, the market's moving against you, you're losing money, and you need this money to pay rent. Maybe you need a new car, maybe you need some medical thing, whatever it is. And you're in a drawdown. And then you're going to try to go, okay, how do I get out of this quickly? Well, I can buy some call options in something silly. I can do this. And then you just continue to kind of like get into a deeper drawdown. I think it's always going to be tough. I don't know anybody I've ever found that is very objective as they trade for themselves for a living. Even though some people will say, yeah, this guy over here and this guy selling this service. And I'm like, yeah, because he's selling that service. The service is keeping him alive as he's in this, 50, 60% drawdown. And not to mention, most of these guys don't talk about drawdowns. Let's just start there. Most of these guys pretend there's no such thing as drawdowns, and they just their stock portfolio just goes up every single day. Like, I post when we were in the Liberation Day moment, we went from, I want to say 33% in the portfolio, 40 overall. We were over 40 overall, and then after Liberation Day, we came all the way back to about 20. Now we're back to those points, and like we're fine. But like that's what I just try to show what real trading is. Like real trading is like there's drawdowns. It's nasty. I have bad times. I have bad days, just like any other trader. The only difference now is like it doesn't bother me as much. It still bothers me. I'd love to go green every single day, but like I have a red day. It's not the end of the world. Oh, Trump did Liberation Day. Okay, I'm down 15%. Who cares? Like you're able to like really be objective about those things, and I think that's the way you really do it.
So I couple of months back I put up a post saying I'm short Palantir right ahead of the earnings. The stock went right down, and everyone's like, "Oh wow, we are a genius." And then a couple of weeks later, the stock went straight up, and then they're like, "Oh my god, you're an idiot." And I was like, "It's one trade. Get it right or wrong, it doesn't really matter. Especially on the short side, it doesn't really matter because on the long side, like the winners can run 100, 200%, and I had quite a few of that in the gold mining space. On the short side, what is the maximum that you can make unless you're pyramiding? And I don't pyramid on the short side. I do pyramid at times on the long side, but never on the short side. But the number of engagements I got for that post. So I was actually up on my holiday in the mountains, and one day I just opened Twitter just to check my notifications, and everything is Palantir. I was like, wow, this is a stock that has driven the bulls so crazy that they can't find anything to do but attack my short post. I was like, but that's how it is. And real trading means you have those losses, you take them, and you move on. And forget about talking about drawdowns at the portfolio level. I think it's a lot of people who attack me. I think they get surprised because I come out and say that yeah, I had some bad trades, and when I say I had those bad trades, they forget all the other good trades that I had. So, for instance, I've been talking about bonds, and you know this, and everyone who followed me last year know this. Bonds was one of my best trades last year, and it was completely a contrarian call, and it worked extremely well with almost no drawdowns. And now I wouldn't touch those bonds. It's
Yes.
a trade I just wouldn't touch, and that's real trading. Like when you have a setup where it makes sense to you, whether you're using trend or fundamentals or a mix of everything, like what I do, it makes sense. You take it and you're done with it. And
Yep.
sometimes they don't work. And that's the truth. Sometimes they just don't work. And sometimes you can put on 10 different trades which you think would work and hit a zero on all of them. And that happens too. And at that point, what do? You just pick yourself up and move on. And if you're just focused on all the negativity people are throwing at you, then there is no way to recover. So, because I've been through this, because I've been very active on Twitter since I started my journey, and you know this. So I started my journey when we were writing against all odds together, and since then it's been a massive learning, and I built up a great following. So it does help to put my ideas out, get the backlash, get the good arguments from others who are taking the other side of the trade. But at the same time, I think focusing too much on Twitter, focusing too much on the negativity doesn't really help. So what I've done recently is whenever I see all these unverified accounts, they just come and post shit like, "Oh, you're stupid" or something. I'm just like, mute,
Yeah.
done. I don't need the spam. There's always a spam which says follow this trader for something, and
The
that
best trader ever. He
yeah,
called it.
that's on every post. It's like there are 10 of those, and then you have these one-line comments, or I would be talking about bonds, and someone would come and say, "How is your Palantir short doing?" And I'm like, "Okay, I'm going to mute this person. I need good engagement. I need to talk to the audience who likes what I share on Twitter, and not talk to the audience who just want to do it as an ego boost. Because if you're doing it as an ego boost, I mean, nothing wrong with it. Maybe you have other jobs where you make money, but if you're treating trading as an ego game, I am 100% sure you will not succeed, because the market will always find a way to kick you in the balls, and that's going to happen. And if you still don't give up your ego, it's going to kick you again and again and again until you do.
Yes. And speaking of that, this chart was up there. I think I posted this chart like a week or two ago. And I don't even remember what I said in it, but I remember this comment that came up, which is, how can you say that there's been three times commodities have gone up or four times commodities have gone up if this chart only go like, and you're talking about the 70s. I'm like, what are you talking about? Like, I didn't say anything about the 70s. Like, people just like to, and the one thing I've learned over time, which is people just like to feel themselves. Like Beth told me that a long time ago. She's like, just let them feel themselves. And like, so I just let people go nuts. Like, there's a buddy, Larry. He's always posting great stuff, hostile charts. And so like he told me a while ago, like we were at New York, and he was like, "Oh, I just write doubt it," back to him. And so I just started doing that. Whenever anybody says something ridiculous, and people get really hyped, really mad for no reason. I don't even know why. Like I try to just stay out of it as well, because it's like nobody's ever going to know your strategy completely. And if it works for you, great. Like that's the goal of anything that I do, is to teach people that one thing is like, yes, I can show you what I do. Yes, I'm a good trader, but you can't do exactly what I do. Not because you're not capable, but because you're a different person and you have different dynamics and your life is different than mine. And so, like, maybe you don't need to trade futures. Maybe you're not a trend guy. Maybe you need to understand, like, why this thing's moving to get involved and be excited about it. That's all fine and good. Because guess what? Like, the Market Wizards books teaches us the most about trading, which is there is no one strategy. like that's the first thing that you learn from those books. There is no one strategy. There's Ed Sekoto, who's like, yeah, it's going up, I'm long. It's going down, I'm short. Like, that's it. All the way to Bruce Kovner, who has to understand the technicals and the fundamentals, and then all the way to people who do market positioning or event-driven trades and so on. Like it's endless. But just figure out what works for you. But I have to go in a second. You got anything to end on, Kashat?
Yeah, can we skip to the last slide, because this is something I want to touch on,
Yep.
given everything that's happening with the dollar. The chart on the Fed.
It's only going there. Let me might need to
Okay.
refresh it.
Okay. So everyone's talking about treasuries. So you have Howard Lutnick coming out against Powell. You have Trump coming out against Powell, and everyone talks about de-dollarization. And I see these charts where people say foreign holdings of treasuries is going up, and they just look at that one data point and think all this FUD about the dollar, about treasuries is wrong. So I have a chart which shows something very different, and this is let me just read it out so
I got it.
can. Okay. So there you go. So what does this tell you? So what this tells you is foreign holdings of securities is going down. It peaked in somewhere around 2021, and it's been going down since. So what this means is investors very clearly are withdrawing their capital from the United States. And I'm not talking about the mom and pop investors, I'm talking about the big institutions, the big foreign accounts, the kind of accounts that the Federal Reserve tracks. So you see this trend, it's very clear. It tells you that capital is moving out of the United States. So sure, you can look at US foreign holdings of US treasuries and see it going up, but you're not seeing the other side of the equation. You're not seeing the treasury issuance going up, and you're not seeing this side of the equation, which is the de-dollarization happening in practice. In fact, this chart actually made the news on Yahoo Finance, and that's how I came to know about it. And once I saw it, it's shocking. So I will leave you with this because I think this is the clearest picture which explains why the dollar keeps falling no matter what's happening.
No, I like this. I'm gonna have to look. Send me that article on Yahoo. I'll post it in the description for everybody on YouTube as well. But yeah, I want to see that because I haven't seen this chart in years. But man, that's shocking and spot on. All right, guys. Well, thank you so much for joining us. I gotta go. I got another meeting, but I will see you guys soon. We'll be back hopefully next week. I should be a little bit more consistent on this now, and we'll see you guys soon.
Bye, everyone.